All right, I'm here with Bill Vlahos, who is my favorite financial planner, and he also does some lending. I love the combination of the work that he does because a lot of times I feel like when people are thinking about a loan, they also need to think about their whole entire financial picture. So it's very rare to have that skill set where you can do both. And so I love for Bill to be able to kind of take an organic approach to helping my clients think through the process of getting a loan, but also just all of their financing in general. And, I wanted to jump, and there's Nikhil in the background because we're sheltering in place. Say hi.
Hi.
And he's supposed to be in school. Is this recess time?
Mm-hmm.
Okay. Can you have recess outside this room, please? Okay, go. I wanted to have a conversation with Bill to just find out like what's going on out there. What are people talking about with regard to financing? And Bill, do you want to introduce yourself? Did I miss anything?
No, I think as usual, you're spot on. So I grew up in San Francisco. I went to school at UCLA, moved back in the Bay Area after graduating, and I've been working as a financial advisor for 25 plus years. Our firm is 20 years old. There's 15 of us, 4 partners, 8 support staff. And as you alluded to, the core of what we do is investment management for individuals and families, understanding everything we can about a portfolio and then designing it based on the client's income, trust situations, goals, risk tolerances. And wrapped around that, we do financial planning, stock option planning, estate planning. I'm a licensed mortgage broker, so we provide mortgages. And then we also have a big employee benefits practice. And because I'm a Gemini and I don't have enough going on, I also do some expert witness work. So I do expert witness work on suitability of investments, standard of care, fiduciary care, things like that.
Awesome. Yeah, you do have a lot going on. So I'm sure, like me, you're probably feeling, I feel like a lot of my days right now are being on the phone, talking with sellers, mostly about like easing some of their anxiety. And so you must be getting a lot of, your phone must be ringing off the hook right now with the stock market where it is. What are clients talking about?
Well, I think, if you take a step back and first paint the picture of where we are. So as we entered into the year, the stock market was trading at the higher end of valuation, no question about it. So, a common multiple of valuation is a PE ratio, the price that you're paying for earnings. And that number was just about 20, and that's historically high. So if you were to factor in low interest rates, traditionally stocks traded PEs of 17, 18 in this interest rate environment. So I think the market, first of all, was susceptible to a pullback. So that's the first thing to keep in mind. I think the second thing to keep in mind that these are very much uncharted territory. So as a young financial advisor, I lived in practice through 9/11. I lived in practice through the recession of the 1990s and the internet bubble and 2008. So I've seen a lot, but this is fairly unique. So even in 2008, initially I thought this may not be as bad as 2008, but now I think it potentially could be worse because in 2008, you certainly had banks failing. And Bank of America stock was at $3 and you had financial institutions failing, but now you have a complete seizure. So the US economy is primarily driven by the consumer, and that's obviously been frozen. So it's not just the restaurants and those sort of gathering places, but it's the dentist who may have bought a practice, who has high fixed costs, is leasing equipment, has employees. So it's really frozen the economy. But this will end at some point. And so I think the big question going forward is, how does a consumer behave when this is over? Will everything go back to normal? Will there have been so much damage that consumers don't want to spend? I mean, a key component of economic growth is velocity, the velocity of money. How often does money circulate? And right now it's not circulating at all. But when this ends, and hopefully that'll be soon, will people go out to dinner again? Will people get massages? Will people buy real estate? So I'm eager to hear what you think about this. So I think a lot of it is, to what degree does normalcy return? And I don't think anybody knows right now.
Do your clients, I'm sure that one of the things that financial planners talk about is diversification, for the assets. So were they diversified with cash and stuff like that? Are they in a good cash position?
Yeah. So one thing that we are absolutely dogmatic about, and what I like to say is know thy bucket. So I think, every investor should have different buckets for their portfolio. So there's a bucket of emergency money. in case, there's a 9/11 or a pandemic. There should be money that they need, intermediate money and long-term money. So we're dogmatic that we insist or strongly encourage the clients that any money they have in stocks or real estate for that matter, they don't need for a minimum of 5 years. And a minimum, because I've been doing this for over 25 years. In my experience, are the clients that have accumulated the greatest amount of wealth are the people who never need to sell during the inevitable bad times, that they can write it out. So for example, if you invested money right before 2008 and then experienced 2008 and experienced now, you'd still be dramatically higher than where you were. So most clients are not freaking out. Most clients know that because this will recover. And I guarantee you that, I don't know, 2, 3, 4, 5 years from now, stocks are going to be dramatically higher than they are now. I don't know how long it'll take or when. So I think it's just really important that people who who are paying a mortgage, they're not having that money invested in stocks, but it's money that they have for their kids' college or their retirement. So as long as people have it in the right bucket, they're going to be fine.
What percentage of your clients, like wanted to sell as the market started going down?
Almost none.
Good. Okay.
Almost none. Because I think people realize that, people who sold in 9/11 or 2008 sold at the bottom, they generally didn't get back in.
Yeah.
Right? So I think everyone realizes it. And in some ways, it shouldn't really matter. Because if you don't need the money,
right,
it doesn't really matter.
Right.
And it's painful, but it doesn't really matter.
Yeah, that's where we are. I mean, I feel like it's like, oh, okay, yeah, it's a bummer that we lost it, but it wasn't that, it's there for retirement. So it's like, I know it'll come back. I did go through 2008 and I was much younger then. So it was much scarier.
You were all much younger then. But I think you learn these lessons, and I think, I want to hear about your practice, what's going on. But I think if you think about it as a nation, these are scary times, but, we as a nation, we defeated Stalinism and Nazism, and we went through the Cold War, and we went through 9/11, and we went through 2008. And, we have the strongest economy in the world. And, stocks are a reflection of that economy. And so, things will be dramatically higher down the road.
Right. So for your clients that were wise enough to be in a good cash position, what are they investing in now? Are they talking about real estate at all? Like I've heard some of that from some financial planners where people are saying like, oh my gosh, maybe we were a little stock heavy and maybe it would have been better to be diversified into real estate. So maybe now's the time, or are they too scared because now they would need to pull money out of stock and they don't want to pull money out of stock to buy real estate?
So that's a great question. I think in terms of, in general, what do people do now? So if you have cash, is it a good time to invest? So I think my gut is that you're going to see more so we'll start with stocks and go to real estate. I think you will see more, there's a good chance you'll see more weakness in the market, but maybe not. So typically what happens, there's periods where the market is trying to find a bottom. I think that's going on right now. It's called backing and filling, and the market goes up and goes down. It tries to find a bottom. So could there be another 10 or 15% down? Absolutely. But I think in some ways for people with cash, it doesn't really matter. If you're putting this money away for especially 5, 10, 15 years, 15 years from now, you're not going to know if you bought today and it went down 10%.
Right.
But it does, in some ways it doesn't matter. Although I think for people who are investing in equities down, taking advantage of their cash, just keep in mind it could go down further. And I think real estate is a similar thing. I want to hear your perspective, but when I bought my house, I never really thought about what the value is. And, for, our clients' real estate, I don't think they mark to market every day like they do with stocks, where you see the valuation every day. So I think one of the nice thing about real estate is those values are, you may have an idea, but they're a little less concrete than, well, gee, what's the exact value today? But I think, real estate absolutely, is an important part of a well-diversified portfolio. And I would suspect those basic principles are the same, that if you don't need this money for some period of time, it's probably a great time to invest in real estate. So maybe we can start talking a little bit about your perspective and what are you seeing out there? Do you think that real estate has gone down materially? It didn't seem in 2008 like Bay Area real estate went down that much, especially in San Francisco. So maybe just tell us a little bit about what you're seeing.
Yeah, I mean, I always use 2008 as a benchmark for a worst case scenario because I feel like it's like, I have felt like that was a really, really bad time. And could we actually see that twice in our lifetime? But to your point, maybe we are, maybe this is, maybe we are seeing it twice in our lifetime. Um, I don't think we exactly know where we're at in this position, especially because, as probably most of you know, we're not able to sell real estate right now unless it's sight unseen. We can't actually show it. Most things in the Bay Area are not bought sight unseen. However, I was talking to my coach yesterday, and I said to her something to the effect of like, I'm probably not going to sell a house for another couple months. And she's like, really? Is that true? And I said, well, yeah, I think so. I don't think I can sell a house like sight unseen. And she's like, well, could anyone buy a house sight unseen? She's like, I've bought 4. And I was like, actually, I've bought 2 sight unseen, right? But they were both investment properties. And all I was concerned about was cash flow. So I do think, there is a pocket of that. However, the interesting thing about that pocket right now is given that, San Francisco has delayed rents, right? Like, and evictions, then I don't think investors are clamoring to get in and buy investment properties in a position when they may not be collecting rents. So my guess is that, I don't have any strong data points for you from yesterday because we haven't gotten anything into escrow in the last week. But the weeks leading up were very strong. And it was, even with the pandemic going on, like coronavirus was a thing a week ago still. And it seemed like buyers were just really ready to buy, and sellers were definitely, we were having a pretty great spring. So I don't know exactly what's going to happen. What I do know is that San Francisco, in 2008, it had about a 27% drop citywide, which, considering we had a lot of years where, different neighborhoods were gaining 20% for multiple years in a row, 27% overall was not so bad, right? So I think, in general, San Francisco has been a very strong place to invest, and I think it will continue to be so. And like, I wonder, as people are sitting at home, if their houses are bursting at the seams, and certainly some people are in that situation, and now they're locked inside with their little bratty kids for days on end. It might be
My
when
kids
they
are
come.
just absolute angels. They're perfect.
But they're not coming in the background. But I think that it could be, that they're like, oh my God, now more than ever, we need a little bit more space. And you really kind of start to realize the deficiencies about your own home. Or, I mean, I've been really enjoying my home lately because we were able to upgrade it recently. And so I've been super fortunate to be in here and be like, wow, this has been nice. But I've been thinking a lot about like, oh my gosh, if we didn't do this, what would it be like to be here right now? So yeah, that's where we're at in terms of kind of my thoughts on where things are going. I'm curious, like, if you could name like a couple of things that you think that people could do now from a financial perspective that would help position them, to take advantage. I believe that there's opportunities in all downtimes. So what are the things that people can be doing with their money now in order to make this time an opportunity?
Well, I mean, typically, what markets do is that they undercorrect and overcorrect. So, for example, like I said, at the beginning of the year, stocks were probably on the expensive side, and now you've seen a market that decline over 35%. So, I don't know about today, but somewhere around this process, the market will be finding a bottom, and it will probably overcorrect. So, it'll probably be a good opportunity. The best companies really are in America. You don't see the Facebooks and the LinkedIn and the Apples. These are U.S. companies. So I think people could look at really strong companies. If they like individual stocks, I would suggest that they look at strong companies with very solid balance sheets. You don't want to be stocks of companies that potentially might need to raise money because liquidity will lock up to some degree. So that's one thing. And then I think the other thing that, a lesson that people may have learned is to be careful with their leverage and to make sure that they always have, a decent emergency fund, because I don't think anybody saw this pandemic coming.
What do you think is a percentage of a decent emergency fund?
Well, it depends on the individual and the business. If they have a business that requires a lot of capital, maybe a couple years worth of liquidity. If it's a family, probably at least a year or two in tax exempt bonds or liquid assets.
So if I don't have that liquidity, a lot of my friends are business owners. What do I do now?
Make more sales.
But I can't sell anything, right?
I mean, I think that there's programs that are starting to come out of the city, the state, the federal government. I haven't reviewed them yet. A lot of them are still proposals, but they're all coming out right now.
Yeah.
And you're going to see like the TARP programs were very successful in 2008.
What about like a HELOC? Is that an option?
Sure. A HELOC is definitely an option, but keep in mind that the banks are, that these HELOCs and lines of credit are being drawn on right now. I talked to a banker just yesterday, and so they may be harder to obtain now, but I think going forward, people should, think about these secondary liquidity needs in the future. I'm not saying it's too late now, but they definitely should.
Right. So for those people who don't know what a HELOC is, can you explain how that works?
It's basically a loan against their primary residence.
Yeah. So if you have a little bit of extra equity or a lot of extra equity in your home, it's a way to access that, right?
Right. And then talk to your CPA, because some of these various liquidity programs may or may not be tax deductible. Question for you is, clearly this freezing of financial activity is having a big impact on the commercial real estate market and the commercial landlords. Where do you see that? And do you see a correlation to that to the residential units?
I'm probably not the best person to answer that question because I don't sell commercial real estate. So in my world, it's actually, you have the 4 units and above, and they're like separate. So 4 units and above is commercial and 4 units and below is residential. And I very much stay in my lane. So that's just not something that's really in my world. I would think that it will be frozen, for a while, unless there's massive discounts that are happening. Investors are always happy to take advantage of those times, right? But if we're moving into a situation where people don't have to pay rent for the foreseeable future, you're going to want to have some upside that you can realize. So, as San Francisco's always been a place that's very, very pro-tenant. So I think it is, there's potentially a lot of downside that could happen if you own a lot of properties right now. And I know one of my friends has a restaurant, and she said her rent is like $30,000 a month, right? And it's closed. So I think there's a lot of people dealing with that sort of stuff right now. So,
and do you see, I know you're not on the commercial side, but do you think landlords are going to work with their tenants?
Yes. I don't think they have a choice.
And then kind of speaking, more globally, prior to the pandemic, we see new trends in San Francisco. You have a DA who doesn't want to prosecute a lot of crimes. You see homeless. How has that sort of affected people's attitudes toward real estate in San Francisco?
I do think that the homeless situation, I think it is becoming more of a detractor than it has been in years past. I have, in the recent future, heard a lot of sellers say to me, like, that's one of the reasons that they're leaving. And I would say 18 months ago, I never heard anyone mention that. And in the last 18 months, I probably have had 10 sellers that have said that's a big reason why they're leaving. So that's concerning, right? It's like, probably a good 30% of my sales are saying we're just done with the mess. So I don't know what the answer is to that. I try to do some things like on the grassroots level where, there's a school called DeMariac that we are active, donors to, that's 100% like run by the community through donations. And it's like in the Tenderloin only kids that live in the Tenderloin can go there, and it's a free education for them where they're really, oftentimes they get them into Sacred Heart or different, Lowell is another one that takes a lot of them on. I think SI as well, which I know you're an alum of, Bill. They go there a lot. And so, through these scholarships, and then the school follows them through, and then they're really teaching them these values about coming back and reinvesting in their community. And like 80% of them or something come back. I think 90-something% go to college, which is like amazing considering their backgrounds. It's higher than like normal graduation rates. And then 80% of them come back and work in the community to give back, because that's the way they're kind of raised by the school, is like, we have to take care of each other. And so even though programs like that are not sexy because they take 20 years, right? But those are the boring kind of programs that I think could actually really change things. And I think that everybody wants a really quick fix. And I mean, I've been living here now for almost 20 years, and we've been talking about this since I moved here, and it seems to not be getting better.
Right. I guess the one nice thing is there's a big bay in the way. So, and they're not building, I don't think, any new single family homes in San Francisco. So it seems to me that to some degree that real estate should always do okay.
Yeah. I mean, it's a 7x7 city, right? And I think that we are in a fortunate place where, we're in the heart of Silicon Valley. So there's just a lot of really, really top talent and some of the smartest people in the world that live here. And these, companies that you're talking about, the Facebooks and the Googles and stuff like that, they are moving around, right? They have offices everywhere, but I think their headquarters are always going to be here. So we have been able to really benefit from that in the housing market. So that has, I think, propped up the housing market and kept it really strong. And I think we'll continue to do so. I'm curious, you mentioned blue chip stocks, like some of those blue chip stocks. So if I were choosing a stock to invest in, what are some good buys that you see right now?
Well, I wouldn't really feel too comfortable, talking about individual stocks, because our lawyers wouldn't like that very much. But I'll just say that, sticking to blue chip companies, and if you really don't feel comfortable, the ETFs, the indices that own the whole market, I think, you're going to robustly benefit if you're buying those ETFs now or next month or two, and you're putting that money away for 5 or 10 or 15 years. I think you're going to do really, really well.
So that's like an index fund, right? An
index
ETF.
fund, or a Vanguard fund, or an active management. I don't think it makes that much difference as long as you're well diversified. Mm-hmm. It's not really going to make that much difference.
So if I'm if I'm a person who hasn't gotten involved in the stock market, but I happen to, have $100,000 or something sitting on the side, and I have a secure job and I don't feel like I really need it, then I could just, if I haven't already, open a Vanguard account and maybe buy a little bit of stock day by day, or what's the best way?
Yeah, I think that's really prudent. So, an odd thing that for people who make systematic investments called dollar cost averaging, most commonly through their 401k plan, it really works to their advantage for the markets to be down, because especially if you're making a systematic investment, a certain dollar amount every payroll or every month, you're actually buying more shares when the price is down. So it actually works to your advantage for the markets to go down, especially if you're making systematic investments either through your taxable or your 401k, because then you're accumulating more shares. As long as they eventually rebound, you're going to do a lot better, having lived through these periods, even though they may be a little unpleasant.
Got it.
One of my final questions for you is, for new buyers, are there certain neighborhoods that you think represent especially good value? So for example, I grew up near West Portal, and my understanding is you can get a lot more for your money than you can in sort of the western part of the city. And I think it's a great community. Thoughts on neighborhoods or strategies for people who want to maximize their real estate purchases?
I love West Portal. I think it depends on what your price point is, right? So we actually do sell a lot of houses in West Portal, and it's generally a client who was trying to get into Noe Valley, and they wanted to get into Noe Valley for like 2.5 right? And we, and buy like a 3 or 4 bedroom house. And, a better price point in Noe Valley for a 3 to 4 bedroom house is like, depending on, for like 3 to 5 million, to be honest. So if they had a price point like that, then we would be looking at areas like West Portal. We would encourage them to look at areas like West Portal, a little bit in St. Francis Wood, but the houses there are bigger. So it depends on the price point, would depend on kind of where we would recommend. But the thing that happens in San Francisco, as the market shifts, and I don't know for sure that it is going to shift, but my guess would be that we'll see some softness coming out of this, is that, if you started with Pack Heights, like as say the center of, or the beginning of like a tidal wave, as the market goes up, like the tidal wave moves over. And so as people can't afford Pack Heights, then sometimes they might move, start moving like west or moving out. So they might decide like, oh, well, maybe we'll look at Noe Valley. And then as Noe Valley goes up, then it's like, okay, maybe we'll look at Glen Park or Mira Loma or Sunny. So it's kind of like the further that you get out, like the more of a value that you get, the higher the price, the lower the price per square foot ends up being, so the average price per square foot in Noe for, a nice house is anywhere between like 1,300 to 1,600 a square foot. Whereas in West Portal, you can get a lot for, 1,000 or 1,100 a square foot. So your money does go further there. We've been seeing values for a while in condos, because with the build that's been happening, there's a lot of inventory there. So that market has been softer than single family home, prices have. And then, even within the condo market, there's kind of some subsectors, like, so condos that are, say, nice Victorians might sell for sometimes more than something that's like more of a box type condo in a high rise that's a little bit older, because it's like got charm. And so there's more, there could be like, there's less of that inventory, right? It's all just about supply and demand. So yeah, it's interesting to see that there's markets within markets. And I think I was having a call with a seller today, and they were saying like, maybe we don't want to do all this work that you recommended we do to sell our house, because we're worried about the market, right? And like, so maybe we don't want to spend if we're not going to be sure that we get it back. And my answer to them was, first of all, I'll do whatever it is that you want me to do. I will support you in your decision, but you also hired me to give you my professional opinion. And what I've seen in the last 10 years is that there's been a lot of ups. It looks like the graph has just went in one direction for housing, but actually there's been, last fall was like, the market was really down. And there have been these like micro climates that we've had where it's been down for a season and then it's popped back up, many of them. So we've had some kind of, say, softer markets in the last 10 years. And what I notice every time that we're in a softer market is there tends to be like a divergence between like the perfect homes and the ones that are, I don't want to say deficient, but it can look deficient if it's not staged and prepped and all of those things. And the perfect homes will oftentimes sell for yesterday's prices. And then the not so perfect ones that are, maybe the bedrooms are spread out in different locations, or there could be a lot of things, right? The backyard, you have to walk through a bedroom to get to it. Those ones will sell for even less, so those are getting kind of the massive more discounts. So what we want to do in prepping a home is make it look so good that even if there are imperfections, you forget about them. But it'll be interesting to see. I mean, ultimately it's the seller's money, it's their decision. I think you will start to see, as people are worried about the pricing, you'll start to see people really pull back on that prep work that they do in homes. And I mean, quite frankly, for me, it's
short-sighted, or is it just the reality of their situation?
I think I totally understand what they're going through. I mean, I think it's easy for them to think that way. It's like, oh my gosh, I can't, I don't want to spend money if I'm not sure I'm getting it back. When the market is doing well, you feel a lot more certainty that you're going to get it back. But it's counterintuitive to think that even if the market is not doing well, that it's more important than ever to make those updates. But it's scarier because we're all, like, I looked at like my grocery bill for the first time in like 5 years to be like, okay, do I really need this? Like, where can we cut right now? Just because I want to be very, very careful about what I'm spending, primarily because I want to keep my staff on board for as long as possible in the event that this carries on longer than we think it should.
Be glad you don't have teenagers if you're looking at your grocery bill. I guess the last thing that we probably should mention is interest rates.
Yes.
So, the Fed is cutting rates, and that will help people with affordability of buying new purchases or refinancing. It is a little interesting that actually last week mortgage rates went up. Because there's such a demand. It's a little bit of a funky situation, but there's such a demand, and a lot of the big banks are backed up on their mortgages. So there's a huge demand for mortgages. Also, the CMBS, not to get too technical, but the CMBS market was really messy last week, the mortgage market. And I think there is some concern. I think it's somewhat unfounded, but there is some concern about banks and liquidity, and are there traces of 2008. I do think that market will firm up, and I do think that's a good advantage for people to either purchase with lower rates or to refinance soon. I do think you'll see those mortgage market rates come back down a little bit, which could support buying.
Well, I think also, I was wondering if we're not having new purchases for a while, if some of that backlog on the banks will clear up, and then they'll be in a better position. Cause I know even like last fall, normally like a big bank, if with a fast appraisal or whatever, you pay extra for the appraisal, they could turn it around in like 2 days. And we were seeing like nobody of every escrow that we had, it was like 20 days to get an appraiser in the house. And that was in the fall, right? Because rates were so low and like all the banks were just backed up. The appraisers were backed up. I was like calling and throwing fits, like, you got to be kidding me. I've never waited this long. And it just was the same answer from every bank. Get over yourself.
The good news, in some cases for the refinancing, oftentimes you don't need an appraisal. If the owner has a lot of equity in their house, you don't necessarily need an appraisal. But you're right. And right now, my understanding is appraisers are not allowed to work in San Francisco.
Yeah, I've heard different things. I've heard that I think was First Republic's going to be doing drive-by appraisals. And I think it was either Wells or B of A announced that they just would look at it and kind of like do what do you call it? Like a computer appraisal or something like that, like data appraisal.
Yeah.
So yeah,
some of that as well.
Yeah.
Well, this was great. I don't know if you have anything else, but I can tell you that all the clients that I've worked with you love working with you, and they love your professionalism and your attention to detail. And they also really love that you have a whole team around you.
Awesome. Thank you, Bill. Likewise, my clients love working with you, and it's good to have, a good team, of professionals around to refer them to. And I love being able to have these conversations with you so that I can keep educated, and thanks for educating me and my clients today. I really, really appreciate your time.
Likewise.
Awesome. I'll talk to you soon.
Talk to you soon.
Okay. Bye.
Bye.